Hi everyone, I'm Kathy Chrysler from Netcapital, and today I'm going to walk you through 6 proven strategies for funding your startup. So let's get started. Let's start with friends and family. This is often the first source of funding when you're at the very early stages of your startup. It's about getting the ball rolling, whether you're developing your product or proving market demand. But remember, your relationships are on the line, so it's crucial to approach this professionally and clearly define expectations. So here are some key points. This is typically used when your company doesn't have significant traction or a product yet. Investors are often people who trust you personally, so it's important to manage expectations and be transparent about the risks. Now, why is it important to have friends and family invest? Because having your close circle invest in your business shows future investors that others believe in your vision. If they see that you've already secured funding from people who know you best, they're more likely to feel confident about jumping in. Without this backing, investors might wonder, if your friends didn't invest, why should I? Now, when structuring the investment, there are a few common ways to do this. Let's start with a SAFE, which stands for Simple Agreement for Future Equity. A SAFE is one of the most common options, and it's a simple agreement that lets investors convert their investment into equity at a later stage, like during a Series A, without having to establish a valuation up front. This flexibility makes it easier to raise money early on without a lot of red tape. Does it have to be a SAFE? Not at all. Safes are just one option, and there are other common ways to structure the deal, including convertible notes, which are like a safe but structured as debt. It's a loan that converts into equity under certain conditions and typically includes an interest rate and a maturity date. There's also straight equity investments. You could offer direct ownership in your company in exchange for their investment. This is straightforward, but requires an agreement on valuation. Each option has its pros and cons. Safes and convertible notes are simpler and don't require setting a valuation, while equity investments provide more clarity on ownership upfront. Now let's talk about the pros. First of all, you get quick access to capital with fewer formalities. And of course, there's flexibility in structuring the agreement. And additionally, you have strong relationships that help build momentum for future fundraising. But here's what you need to consider. It's still essential to have formal agreements and clear terms to avoid misunderstandings. And the amount you raise is generally limited compared to larger rounds. Now let's talk about angel investors, a key step for many founders looking to raise larger checks after friends and family. An angel investor is typically a high net worth individual who writes personal checks, usually in the range of 5,000 to 100,000 or more. They're accredited investors and they fall into 2 main categories. Individual angels, they invest solo, handle their own due diligence, and make independent decisions. And angel groups, these are networks of angels who meet regularly, share deals, and often co-invest together. Angel groups use their combined experience to evaluate opportunities, and many specialize by industry or geography. Now, here's a pro tip. Some angel groups focus on specific sectors like clean tech, fintech, health, or consumer products, while others are generalists. Finding the right match for your industry can save you time and increase your chances of success. So, how do you connect with them? Attend local events. Angel groups host pitch nights, coffee meetups, networking events in nearly every U.S. city. So look for those opportunities in your area and leverage LinkedIn. Search for angel investor or investor in your region and industry. And don't be shy about sending connection requests and personalized messages. Angels are often open to cold outreach. Additionally, sign up for newsletters. Many angel groups send regular emails about what they're looking for and upcoming opportunities to pitch. And build visibility. Angel investors tend to back founders they've seen in action at events, online, and through mutual connections. Next up is venture capital or VC, the dream for many startups, but also one of the most competitive and complex fundraising paths. Venture capital firms are professional investment groups that manage large sums of money pooled from institutional investors, pension funds, and high net worth individuals. They invest in startups they believe can deliver very high growth and large returns, usually aiming for 10, 20, or more times their investment. But here's what founders need to know. Investment size. VC checks tend to be large, often millions of dollars per round, depending on your stage. Investment size is often a million to 100 million plus. An equity stake, in exchange for that capital, VCs typically want a significant stake, often anywhere from 15 to 30% of your company in a single round, sometimes more. Control considerations. Beyond equity, VCs almost always ask for a seat on your board of directors. This gives them formal influence over major company decisions like future fundraising, hiring, financial strategy, and even acquisitions. Milestone pressure. VC funding often comes with performance expectations. You'll need to hit aggressive growth targets to unlock future rounds. It's a high pressure path geared for scale. Selective fit. Not every company is VC backable. Venture firms look for startups with huge addressable markets, defensible competitive advantages, and world-class growth potential. Total addressable market, or TAM, matters here. Many VCs want to see a TAM of at least $1 billion. This is a common benchmark in the VC world, especially among larger funds. TAM is the total revenue opportunity available if your product or service were to achieve full market penetration. A huge TAM shows that your company has the potential to scale to the size needed for VCs to achieve their target returns. If your business doesn't fit this profile, alternative funding routes like angels or crowdfunding may be more suitable. Ask yourself this: are you ready to trade equity and control for the capital needed to scale fast? VCs can help you grow quickly, but the expectations are equally high. Now let's talk about regulation crowdfunding, or Reg CF. If you want to raise money from your community and the public, Reg CF might be the right fit. This SEC-regulated pathway allows you to raise from both accredited and non-accredited investors, meaning anyone can invest, not just wealthy insiders. The investment range is up to $5 million per year, and it's open to your customers, fans, and supporters. And in terms of equity, you control the terms and valuation. The success of a Reg CF raise depends on the strength of your network and marketing. If you can rally a broad base of supporters, this method offers both funding and brand ambassadors. Another fundraising option is Reg A Plus. Reg A Plus allows companies to raise significant capital, up to $75 million per year, from both accredited and non-accredited investors through what's called often a mini IPO. Why choose Reg A Plus over Reg CF? First of all, higher fundraising limit. Reg CF caps out at $5 million annually, while Reg A Plus allows up to $75 million. There's also a broader reach. Both allow you to market publicly, but Reg A Plus lets you tap deeper into retail investors, institutions, and even create paths for secondary trading on platforms like OTC Markets or NASDAQ. There's also more investor flexibility. You can accept both accredited and non-accredited investors, expanding your pool of potential backers. Now, why is it called a mini IPO? Reg A Plus is technically a public offering, requiring SEC qualifications, audited financials, and former disclosures, similar to a traditional IPO, though it doesn't require listing on a national exchange like the New York Stock Exchange or NASDAQ. That flexibility is part of the appeal. Companies can use Reg A Plus solely to raise capital from the public without listing, or use it as a pathway to list on an exchange like NASDAQ or OTC Markets, depending on their goals. Why choose Reg A Plus over venture capital? First of all, you retain more control. Unlike VC, Reg A Plus investors don't typically ask for board seats or operational control. You also set your own terms. You determine the valuation, price per share, and investor rights, not the investor. You also broaden your investor base. Instead of small groups of VCs, you can create a large, engaged shareholder community, including your customers. And brand exposure is another big reason. Public campaigns attract attention and help build credibility in the marketplace. One example of a successful Reg A Plus raise was EnergyX. They raised 75 million via Reg A Plus. Their company advances lithium extraction technology, and it attracted nearly 40,000 retail investors. While the upfront legal and accounting costs are higher than other fundraising paths, Reg A Plus can give growth stage startups the capital and audience they need to scale without giving up too much ownership or control. Another interesting option not many people know about is Reg D. Reg D allows startups and private companies to raise unlimited capital from accredited investors through private placements with fewer regulatory hurdles than public offerings. Some of the highlights include unlimited capital, accredited investors only with limited exceptions, private placements, and faster and more cost-effective than public offerings. Now, why choose Reg D? First of all, there's no fundraising limit. You can raise as much capital as investors are willing to commit. There are also fewer disclosures. The offerings don't require SEC review or public disclosure of business information. However, Form D must still be filed with the SEC, which includes basic information about the company and the offering, and due diligence materials must still be shared with investors. It's also a different investor type. Reg D focuses on accredited investors only. These are high net worth individuals, funds, and institutions, which often leads to larger individual investments and more sophisticated business discussions. It can also be faster and more cost effective. Since there's no SEC qualification or registration process, you can launch a Reg D offering more quickly and with lower upfront legal and compliance costs compared to public offerings. Now, there are two types. We're going to get into the weeds here a bit. There's Rule 506B. That allows you to raise unlimited capital from accredited investors and up to 35 sophisticated non-accredited investors, but you cannot generally solicit or advertise the offering. Then there's Rule 506C. That allows for general solicitation and advertising, but all investors must be accredited and verified as such. So why choose Reg D over other options? If you already have strong connections with high net worth investors or VC-like relationships, but want to avoid the ownership or control concessions typical in venture deals, then Reg D might be for you. Or if you want to raise quickly, quietly, and with minimal public disclosure, or if your company isn't consumer focused or you prefer not to market your offering widely, as you would under Reg CF or Reg A+. Reg D is a versatile private route that's especially useful for founders who want to maintain control, limit public exposure, and focus on raising from experienced, deep-pocketed investors. Every startup's path is different, and your fundraising strategy should align with your specific business model, network, and growth stage. Whether you start with friends and family, tap into angel investors, or go down the path of crowdfunding or venture capital, it's crucial to do your homework and select the best fit for your needs. Remember, fundraising is about more than money. It's about relationships, reputation, and long-term strategy. Whether you choose one path or several, preparation is key. Build your network, tell your story clearly, and match your strategy to your goals. If you're considering raising capital through Reg CF, Reg A, or Reg D, Netcapital can help guide you through the process. We're here to support founders at every step of the journey. Thanks for joining us today, and best of luck with your fundraising journey.